Hi, I'm Jimmy. In this video, I want to walk through the inverted yield curve. What is an inverted yield curve and why is it important? Now, let's start with the result. The theory is that when a normal yield curve inverts, well, we may be heading towards a recession. So that's the reason why we look at it. Now, since the 1990s, there have been 3 recessions in the United States. The Great Recession from the end of 2007 to about the middle of 2009, the dot-com bubble during 2001, and then to kick off the 1990s, there was a recession then that came from the savings and loan crisis. Now, that one ran from about mid-1990 to about March of 1991. So after we defined the yield curve and then the inverted yield curve, well, I'm going to go through each of the past 3 recessions to see what the yield curve looked like back then. And then maybe we can find some similarities with the way things look today. So the first thing is, what is the yield curve? So basically, the yield curve shows yields by maturity for a similar type of investment. You could have a yield curve for almost anything. You could do corporate bonds or municipal bonds or anything like that. But the most popular one is related to US Treasury bonds. So here are the very basics for a normal yield curve. On the x-axis at the bottom, we have time. And some of the more popular time periods to look at are 3-month yields, 6-month yields, 2 years, 10 years, and 30 years. And then on the y-axis, you have the yield. So this is what a normal yield curve looks like. And the important thing for us to notice when looking at a yield curve is the shape of the yield curve. Notice that it's upward sloping. And this makes sense if we think about it. Don't forget that the yield over here, well, this is how much an investor gets paid for investing in a particular bond. So in this example, if we were to invest in a 3-month bond, well, we would get paid a 3% annual rate. And if we were to invest in a 10-year bond, well, we would get paid, in this case, a 6% annual rate. And getting paid more money for investing in longer-term investments makes sense, since in theory, the longer you're in something, well, the more risk there is, and the longer you have to lock up that capital, so you should get paid a higher rate of return. So this brings us to the inverted yield curve. So basically, the inverted yield curve is when the yield curve goes down. So why is this bad and how does this happen? Well, this is bad for banks. So banks typically borrow on the short end of the yield curve. Maybe that's what you or I get paid based for our savings account, or maybe that's what the bank borrows from the Federal Reserve. Basically, what they pay out in interest is based on short-term rates. That's why those rates tend to be so low. But when they lend money, they typically lend money at longer-term rates. Think mortgages. So now they borrow money at short-term rates and they lend out that money at long-term rates. But if short-term rates are higher than long-term rates, it's going to be very difficult for that bank to lend profitably. So what do banks do? They often stop lending. And as we can imagine, if they stop lending, that's going to be a bad thing for the economy. Now, how does this happen? So now let's switch this chart from an inverted yield curve to a flat yield curve to demonstrate how this might happen. And it's important here to remember what happens when investors buy a bond and how the yield is calculated. So if we were to buy a bond and that bond cost us $100, and that bond is going to pay out $3 every year. Well, we take that $3, we divide it by the price we paid, which is $100, and we get a yield of 3%. Simple enough. But now what happens if a ton of investors start buying a bond with just one maturity? Well, thanks to supply and demand, well, the price of that bond would start to move higher. So what if the price, instead of being $100, was now $120? We get the same $3 interest payment on an annual basis, but this time the cost is $120. So you take $3 and you divide it by $120 and you get a 2.5% dividend yield. And this is actually how you end up with a normal yield curve. See, if the yield curve were to be flat, why would anybody invest in a 10-year bond or 30-year bond when they could get the exact same rate of return for investing in a 3-month bond? See, that's what most investors do. In theory, they sell the 10-year bond and they buy the 3-month bond. 10-year bond, because it's getting sold, falls down, the yield moves higher. The 3-month bond, more people pouring into it, price moves higher, yield falls. So you end up with a normal yield curve. And that makes sense. Now, there's also the impact of the Federal Reserve. And yes, they have a big impact on rates, especially short-term rates. But they don't actually set any of these rates. They actually set overnight borrowing rates, which they call the Fed funds rate. And although they don't directly control any of these rates, they can have a big impact on them by adjusting the Fed funds rate or shifting monetary policy in one way or another. If you're interested in learning more about the Fed funds rate, I have a link in the description below for a video I made on that. Okay, so ignoring the Fed or monetary policy, let's just leave it to the impact of the market on these rates. So what if people or investors start looking for safe long-term investments? We'll call it a flight to safety because they're worried about the market. Well, maybe investors want to lock up their money for, let's say, 10 years. So they go ahead and they start buying the 10-year bond, and the price of those bonds start to rise. And the price jumps to 120 and the yield falls down to 2.5%. And then more investors pour in as fear becomes more widespread and the price climbs to 140, dropping the yield even further down to 2.14%, and so on. So basically, it's often fear and a flight to safety that causes the yield curve to invert. So this brings us to the current yield curve. Now, as we can see, this line is not nearly as clean as the line in our examples, but if you saw some recent headlines saying that the yield curve recently inverted, well, this is what they're referring to. Now, many economists look at the spread between 3-month Treasury bonds and 10-year Treasury bonds, and they look at that spread to determine whether or not there's an inversion of the yield curve. Right now, if we invest in a 3-month Treasury bond, well, we get 2.45%, and if we invest in a 10-year Treasury bond, we get 2.43%. And that spread means that it's 0.02% negative. Economists also use a 2-year spread and a 10-year spread. You can use either one. And one thing I want to point out is that all these interest rates you see, they're always quoted in an annual basis. It's not 3% for 3 months. It is 3% over a year. Divide by 4 if it were just a 3-month bond. Divide by 2 if it was a 6-month bond. So what does this mean for the economy and for the stock market? Well, the first thing is, there's a joke that I've heard a few times that is that the inverted yield curve has predicted 12 out of the last 7 recessions. And basically, this means that just because a yield curve inverts doesn't mean that there will be a recession. It's been wrong before. So if we go to the savings and loan crisis of the early 1990s, well, there was a recession during that. That's the chart of the S&P 500. That was a recession during that time. And the yield curve inverted right here. Now, if we were to zoom in closer and look at the yield curve, this is what that looked like. And what they were paying attention to at the time was the 2-year rate compared to the 10-year rate. But if we were to flip back to the S&P 500 chart for a second, we can see that the yield curve inverted more than a year before the eventual recession happened. Now, jumping over to the tech crash, this is the S&P 500 from that time. And the economic recession happened right here. And the inverted yield curve came about right there. Now, I think it's important to note that you can't really tell in this chart because it's pretty compact, but it was just short of the high of the stock market when the yield curve actually appealed. I also think it's important that each of the yield curves we're looking at, when they got there, they stay inverted for at least 10 days. So this isn't just a quick dip into negative territory and then they bounce back. All of these examples stayed there for at least 10 days. Although in this case, the stock market actually started to head lower shortly after the inverted yield curve appeared. But after the inverted yield curve appeared, it was a little bit of time before the economy went into a recession. This is actually why they call an inverted yield curve a leading economic indicator. So this is what the yield curve looked like back before the dot-com bubble. And as we can see, the 10-year bond and the 30-year bond are way lower than the rest. Okay, now on to the Great Recession. So once again, this is the S&P 500 during the Great Recession. And this is when the yield curve first became inverted. And once again, just like we saw in the early 90s recession, we can see that the stock market continued to climb for quite some time after the yield curve became inverted. And this is what the inverted yield curve looked like before the Great Recession. And we could see that the 3-month rates and the 6-month rates were above the 10-year rates and the 30-year rates. So clearly this is a bad thing for banks. Now, jumping back to today's yield curve, well, the answer is yes. The 10-year rate is lower than the 3-month rate, and this is a bad thing. In my opinion, what we need to do is we need to watch this closely and see how the shape of the yield curve changes from a day-to-day basis, from a week-to-week basis. So we saw in previous recessions that there's no right or wrong way for a yield curve to become an inverted yield curve. And we also need to remember that just because there is an inverted yield curve doesn't mean this will always lead to a recession. So we have to weigh as many factors as we can. But all recessions have been preceded by an inverted yield curve. So for me, I'm going to stick with the same conclusion that I had in my leading economic indicators video, link in the description below if you're interested. And that is that I believe it makes sense for us to stay fully invested, but I think it's also smart for us to have some defensive holdings, maybe bulk those defensive holdings up. But what do you think? Do you think that there is a recession that's going to happen over, let's say, the next year or two? Let me know what you think in the comments below. Thank you for sticking with me all the way to the end of the video. If you haven't done so yet, hit the subscribe button. Thank you very much, and I'll see you in the next video.